Perfect. So this panel is entitled Financiers Discuss Trends and Credit Requirements. We heard from the owners that, okay, finance is available. Maybe a few of those owners, a lot of those owners don't really need finance at the moment. But the financiers have to stay busy, so they must be doing something. So that's what we're going to hear about now. Our moderator is Alexia Hatzimichalis, partner and head of the Athens office of Watson, Farley and Williams. Alexia, please.
Thank you, Kevin. Can you hear me? Not yet. Now? Yep. Yes. Okay. Thank you. So let me introduce you to our panel. Iraklis Tsirigotis. He's the director of Origination of Neptune Maritime Leasing. James Stove-Lorentzen is the managing partner of NorthCape. Wilhelm Magelssen is partner and fund manager of NRP Maritime Asset Management. And Nicholas Petrakakos is partner and managing director of Alantra. So we heard now what the owners have to say. It's now hearing the same, more or less, things, but now from the financiers' perspectives and the advisors. So we only have half an hour, so let me start. My first question is, as we heard, it's an owner's market, and financiers are competing against each other for the best deals. It's not options, it's the best options. So what would you advise a shipping company looking to finance or refinance its vessels? Look locally, Far East, West? Of course, that depends on the company and the type of vessels they have. But I would like to ask the advisors of this panel first to tell me their views. Like Nicholas, if you can start.
Yeah, of course. Thank you very much. As the previous panel mentioned, there is a lot of availability of capital, not just as amount, but also a lot of different options. It's a situation that's very different from 5 years ago. So people sort of don't know how to react to it. It's one of the first times in history that there is a lot of bank financing, leasing financing. All of the funds are very active. There are more funds than there were in 2019. So it's a bit counterintuitive having so much capital available and still having so many options. So in that respect, I think the wisest thing to do is, of course, hire an advisor to do the work for you. In the sense that all these options are not very well known. There are peculiarities in all these setups, all these structures. You have different people and different mentalities running its business and its sector. And of course, not every financier or every product is applicable to every project. So you will hear a lot, especially here in Greece, that I know this guy that got SOFR plus 200 from Eurobank. And they refer to the likes of people across the street or next door. And the client is not that. So a lot of the work comes in a sense of explaining to the client what the real options are there. So, okay, we have all these options for financing right now, but realistic options are maybe less, or maybe there are other options that the client has not taken into consideration. And that's where we come in as advisors, to open that market in a similar manner that a chartering broker would open the market for chartering for an owner.
Thank you, Nicholas. James?
Yeah, I think that it's very interesting the way that Marine Money has put together this, because I found it useful to sit and listen to the ship owners before we come on, and then, hopefully we're not going to disagree with them. But one of the things I really agreed with the last panel was the importance of diversification. And it is very difficult, if you're living as an intermediary, to convince someone to take on debt when they don't need it, don't want it. And at the end of the day, the only real good argument that we will have is that you need to diversify your lending. Right now, we know that the Greek banks are supporting, and they're ultra competitive in their terms, and they should take that, some of it, to keep that relationship. But that's the exact same argument to look to Japan, to look to China, to look to the European banking market, to the KS, the market. Just having either the experience or a little bit of exposure means that when one market closes, you can rely on another one. And in good times, you can afford to pay a little bit, to have a little bit of debt, to go completely, net debt zero. I don't think is a very good choice, long-term strategic planning for a big company.
Okay, thank you. I don't know if Iraklis or Wilhelm want to add anything on that, or I can move to the next question.
Yeah, you can go to the next question, but I think not all ship owners have red carpet access to all the financiers in the world. Just here in Greece, how many ship owners do you have? 400, 500, 600? They're not all financed by Alpha Bank and Eurobank. So I mean, there are, in the lower space where we operate, you know, in the $8, $9, $10 million ticket loans, there are fewer options.
Thank you. Iraklis, can you please give us your view on the market and also let us know the type of transactions that Neptune focuses on and the client profile? And where do you see opportunities in this market? And what do you consider is your competitive advantage?
That's a full question.
Yes, I can repeat if you...
When you say market views, I guess, you know, generally speaking.
Yes, but
generally,
yeah.
most of the markets are quite elevated, to say the least. So that's not new. It has been said quite a few times in this conference and other occasions. So in that regard, a financier job is more difficult nowadays. That's not a secret. But still, there are opportunities to be exploited. Not so much, I will say, in the domestic market, which is extremely competitive for the reasons that already have been said. But more of the opportunities that we see nowadays are in other areas, regions, ranging from Middle East, rest of Balkans, occasionally, few deals only, but still there are, and other areas that are not so well banked. For instance, Turkey, or Turkey, is a pretty significant market. Guess how many banks are active there? Less than a handful, which creates a very interesting dynamic there. It's a market that has deleveraged a lot, and I'm giving that as an example that looking only in the Greek market is not entirely representative of what's happening in the rest of the globe. Now, in the segments that we are mostly active, still remains offshore, the main segment. We think that it's more balanced than the other segments in terms of the risk that we need to take and the return that we can achieve. But also in terms of competition, it's not that significant as it is for the other segments, given that most of the banks around the globe lost billions and billions over the last 10, 15 years. So therefore, they are still very much hesitant to expand the business. And if I look forward, I probably will bet still that offshore will remain the segment that will be doing more business going forward. With dry bulk being the second, however, as it was mentioned in a few sessions, the disconnect between price and charter rates is so significant that poses a great challenge also on the risk side.
Thank you. Wilhelm, what about NRP? Which is the client profile that you focus on and the types of transactions? And also, where do you see is your competitive edge there?
Yeah, no, so I think we focus on smaller loans, so the sub $10 million space. So we typically finance the ship owners with 3 or 4 ships in their portfolio, wanting to buy a 15-year-old handy-sized Supramax dry bulk ship, buying it for 13, 14 million, borrowing 7 or in plus minus. And I think our competitive advantage is that we are actually in that space where there are fewer, most of our, when we compete, is for the 100% equity buyers. There's not that many other debt providers. I think our competitiveness is probably not on price, but we are indeed super competitive on cash break even because we are really asset focused and we're quite comfortable with the assets we lend to because we also have an equity fund, so we understand the asset business. We have a home for them if we need to. So we are competitive on cash break evens because we can be a softer amortization. We've even financed 22-year-old ships. So I mean, as long as we are comfortable with the asset, we're happy to do it. And we are competitive on speed. I mean, we are mainly in S&P financing. We don't do a lot of refinancing. It's typically when an owner buys a ship, and we are super competitive on speed. We close deals from request to funding in 3 weeks, and not many people can do that.
We as lawyers can do that. Thank you, Wilhelm. In the current shipping market, what vessel types and sectors are most attractive from a credit perspective? Iraklis, I think you answered this question, and why? Are certain vessel types receiving more favorable financing terms based on market demand or other factors? For example, I want to ask, for example, tankers, because of the sanctions, compliance issues that banks face, do you think they are as attractive for banks? That's just an example, but I want you to tell me from your perspective which vessels you think are.
Just a short comment that tankers in general is very difficult for us to consider nowadays. We're talking about, advancing an amount close to all-time high in terms of prices, and also in terms of the margin that we need to negotiate being quite low, because again, banks usually prefer to see the strong cash flow, therefore they can be very competitive, et cetera, et cetera. So for us, it's a segment that we don't see that many opportunities nowadays. But of course, time will tell whether the market will soften a bit or will stay high for a bit longer.
So for you, it's offshore?
Offshore, dry bulk, these two areas is where most of we expand. And of course, we have projects on the other segments, either long-term backed by charter or other occasions where we can take a look. But generally, it's offshore and dry bulk these days.
So I think that, as Iraklis says, you can answer this question as the lender or for his case, or I can answer it on part of an advisor. But I think if we had BOCOM up here, which was supposed to be here, I think the big banks, big money lending is wide open for liquid, whether it be crude or product tankers. I think the terms that you're seeing being offered to these type of large clients, medium clients, even non-recourse financing is unheard of. And it could be worrying that type of debt is being put out there. Again, we heard earlier, haven't seen this since 2007. When you hear things like that, okay, then, be careful if you're the lender. And so, we spend most of our time, because you have to add value to something, we spend most of our time trying to convince both lenders and borrowers that, maybe you should consider looking at offshore. You should be looking at oil and gas from a larger perspective, FPSO, drilling, things that I think we've proven we can't live without. And so, spending time in those markets. But to answer your question, are the banks willing to lend against crude and products? 100%. And more so than it's easier to finance a 67 million LR2 today than it was at 80%, than it was to finance 80% at 42 5 years ago. That was nearly impossible. Today, the door will be knocked down with banks trying to give you that. I don't know. It's an interesting dynamic, that one.
Yeah. Wilhelm, what about NRP?
And I think at the moment I would favor, as a lender, because I am a non-recourse asset lender, I would favor the dry bulk space, because you are closer to the floor in terms of values, and I think the floor is much higher today than it was at the moment you referred to when the Aframaxes was 42. But I also think that you should never borrow 80% to anyone, because then you should just buy the ship and take the full upside. Because if you're lending 80%, you're gonna be equity at some point in time. You're just not getting paid for it. So I think at the moment I would favor dry bulk lending, because we're closer to the floor. Although earnings are not that great, they're okay, and it's a safer collateral for me, at least.
Nicholas?
In my view, what was also mentioned, yes, banks will finance product tankers, will finance crude carriers, but as part of a larger corporate, a larger business. So it might be much harder for the small guys, the 1-2 ship owners, to borrow against, let's say, riskier assets or what have become riskier assets. And tankers will always riskier both from an age perspective, from an incident perspective, insurance perspective. Now, of course, we have sanctions, we have the grey fleet, or whatever we call it these days. So yes, banks, being passive investors in general, would prefer more liquid assets, younger assets, and we see that also today. But back to our first discussion, there is always capital for everything these days. And there are funds that focus on mid-aged vessels, smaller tickets, as Wilhelm does. There are banks from the Far East that would also focus on that. We have completed a deal with Chinese leasing on a 16-year-old ship, tanker, LR1. So there is capital for everything. Of course, yes, if you ask a bank, do you want to lend on a more liquid asset, they will prefer to have a 2024 ship with a 5-year time charter to Exxon, of course. That's by definition. But then is when you also start the competition between a bank and a ship owner, which is by definition an entrepreneur, a riskier person, what they want to do with the asset. So you start all the buts. Okay, they would lend, but. So that's what we see. And I think when the markets drop, then the buts, there are more and more of them. And liquidity is constrained by these subjects, let's say, to each deal. But yes, there is capital for everything, but not from all lenders and not to all projects.
Okay, thank you. Now, let us concentrate on small owners, because we say that there is cash and there is financing. But what about owners that have, buying their first vessel, second, third one? Is there financing for them? What is the option for them? They're
Have
not
an option
so.
here.
It's only me. It's
Yeah, so
only me.
exactly.
It's only Wilhelm.
Yes.
No, there is a market certainly for smaller owners, and smaller owners also access to the banks is very difficult.
Yes.
From a perspective of credit worthiness and balance sheet, most of the smaller size owners don't have a holding company in most cases to own the assets, so that makes credit underwriting a bit difficult. But there is capital for that as well. Chinese leasing aside, which is not, I wouldn't say it's the mainstream solution, most of the alternative lenders, the funds and the leasing companies like Iraklis also, would probably be a solution for that. It's a market that it's smaller than the general shipping market. It needs a bit of hand-holding in finding the right person to structure the deal in the right manner. And in our view and our experience, the most difficult part is to prepare the owner for entering into a financing market in general, and not just going to a Greek bank or a person that they know. But there are solutions from Taiwanese banks are very active in older ships and smaller sectors. There are even private credit solutions from larger ship owners that invest through sale and leasebacks in smaller owner acquisitions. I can think of at least 10 to 15 names that invest in that space. And as Alantra, we've done probably most of the deals are on that, the smaller size, the smaller owners or operators that started owning ships to play the arbitrage between owning and chartering in. So in short, there are solutions of that. But there is also a difference between pricing and between the security that its potential lender may require. Wilhelm here is the easiest guy to work with. It's project finance, non-recourse. They do underwrite the asset a lot, so they spend time understanding the asset and the operator, of course. And once you go towards a banking solution, there is more security into the deal. There is, pledge of shares and all the interesting stuff that you also get. But it's more focusing on the business and the whole market rather than the assets. So, but in that case also, you will require more liquid assets that we discussed before. Once you start getting into niche markets and very small sizes, 3,000-4,000 deadweight, for instance, it might be a challenge to finance those.
I'm going to say something a little bit controversial here. I think it's easier to raise debt on a small transaction than a very, very large transaction. I think what we've seen over the last 5 years is that the access to debt has become more available for everyone, except certain parts of the very, very large markets. And I'm in this case actually thinking more environmental focus, meaning FPSOs. I think this is a market that we've been paying attention to for a while now, because it's a market that the Western banks, not because of choice, but because of regulatory environments, are pulling out of. And this is a market that's been functioning for decades. And it's a gap in the system where it doesn't really seem to fit, because it has long-term contracts, it's multi-billion-dollar assets, but it requires so many banks to agree on one system, on one set of funding, and a lot of them are being pulled out of the market. And so I would say it's easier to find a financing for a $5 million, $10 million transaction than it is to find a $2 billion EPC contract funding out of being built in Korea or China or anywhere. That is actually really difficult.
Okay. Iraklis?
And I would like to give an even more controversial comment
Oh.
to what you just said. That I've heard that there are more options, more liquidity. All these are valid points. Now, I also very much think, not only me, but I think we share the same view, most of my colleagues and I, is that in the medium to long term, liquidity is significantly less than what is needed. And let me give you some very high-level rough numbers. Since 2008 until today, the European banking sector in terms of shipping finance has shrinked a lot, as we all know. All that growth came from Chinese leasing. At the moment, they have close to 150 billion exposure, basically in 15 years. When you ask Chinese leasing house how much new growth there can be in the next 10, 15 years, nowhere near that number. So if the fleet, on average, is more than $1 trillion, and if you have to renew it, because don't forget the average age is 12, 13, 14 years, depending on what exactly you look, we're talking about hundreds of billions that is needed over the next 10, 20, 30 years. Where is it going to come from? We think that we can play a great role in that business, and I think all of us can have lots of transactions to look at and lots of business to do. Still is not enough. That's the controversial comment that I'm going to make. So looking just 1 year or the last 2 years to say that there is so much availability of capitals there, yes, that's true, because there is a kind of a squeeze in the market. The balance sheets have de-risked. There's lots of liquidity in the market. There is no need for leverage. Wait until you need to renew the fleet. And you need hundreds of billions to do that, and there is not enough capacity in the banking world for that to do. So we think that, I will go back to what you said earlier, diversification is key. And not only to say that in order to talk my book, but I strongly believe that it's better to have 15 active relationships that you can easily tap and scale up within a year, because there might be temporary opportunities, rather than to depend on 1 or 2 banks or financiers in general, because they are 50 base points more competitive than others.
Thank you. We touched upon the age of the vessels, and for people, it's, they say that 40s are the new 30s and 50s are the new 40s. But what about vessels? This doesn't apply to vessels. So the age of a vessel is increasingly becoming a key factor in financing decisions. What maximum vessel age are financiers comfortable with, and how they assess the risks of financing older vessels, particularly in light of regulatory changes? Wilhelm, you mentioned that you are quite comfortable with the age of the vessel, but...
Yeah, case by case, obviously, but we start with the vessel, and sometimes we're comfortable with an old ship, and sometimes not, and I think it goes if we're comfortable that there's a usage of that ship, we're fine, and that's all that matters. I think that is, at least my theory, is that we're gonna have to accept older and older ships going forward, because I think there's not capacity for replacement by new buildings alone. I think you have to look more into life extensions, etc. And once the charters accept that, I think the banks will follow. But right now, I think the banks have their own principles, and the charters have as well. But the charters are super commercial, so they say the VLCC is 15 years max, but once it becomes $150,000 a day, they will do 18, I promise you. And they will do 20, and they will do 22.
It's happening. It's happening already.
As long as the vessel is a technical good standard, then it's about the ship. It's not about the age. But we have always been about the ship, not the age.
Yeah, and the owners panel mentioned that the banks that have Poseidon principles wants to do new buildings and younger vessels, newer.
I just want to expand on what Wilhelm said about the age, that informally, it's not carved in stone, there's an age limit, we all know about that. But if I share my experience from the offshore business, where specific areas had a limit carved in stone, like 15 years, not more, no discussion about it, they have increased 20 years. And I'm talking about the very, very, very large charterers, national-owned companies. So it's happening because it's very simple. It's simple math. The average age fleet is increasing. And even if you take into account all the new build vessels coming in, the average age will keep increasing for the years to come. I think in 2 or 3 years, it will be like 14 years, 15. So we're very, very close to the limit of many charterers. So it's just logical that they will need to increase it. Therefore, we are also very active in retrofits, because indeed, I think it will start to make more and more sense.
But a 15-year-old ship is not a 15-year-old ship. I mean, there are huge differences between them, how they are maintained, how much steel renewal they have done, etc., etc. So you can I mean, they have to be safe and they have to be in technical good condition. But you can find old ships out there that are. And I think the requirement should be more focused on that than on the actual date on the shipyard contract.
So retrofit is Botox for vessels.
Yeah, hopefully not Botox. I think it's something because of Botox is. I don't want to offend anyone, but it's like we have a saying in Norway that you shouldn't pee in your pants to keep warm because it will be colder in the long run.
Nicholas, do you have anything to add about the age of the vessel or Botox?
No, more or less is what we discussed, but it's one of the large defining factors of what sort of capital is available for ships. Of course, Chinese leasing is very much focused on newer ships. They would do occasionally older, but most of the deals are new built or modern ships. European banks, because of their own issues, they prefer to have younger tonnage. But I think the 10 to 15, which is, depending on who you ask, is old or new, this is a part of the market that's very interesting, especially for alternative financiers to come in and lend against. But then, you have all the batches, it well maintained, who is the operator, who's technically managing, what they did on the last dry dock, et cetera, et cetera. Offshore space is a bit different, that, as Iraklis said, because there was almost a 7-year period that there was no built vessel through this, no new order in 7 years. So we see that the appetite also of the banks there, and Mr. Stefano mentioned local banks in the Middle East financing those. I think they are the only bank that can finance sort of oil and gas offshore right now. The age is a different calculation there. So as Iraklis said, you had 15, 20-year-old ships coming back to the market. ADNOC will not take them 2 years ago. Now they're fine with it. Qatar Gas is the same. Aramco is the same as well. So it's a different calculation. As long as the commercial side of the business is okay with it, the banks become a bit more accepting to that number.
I remember when we started looking into the offshore segment and a request comes in and says like 2013 built vessels, one of the youngest vessels out there. It's like 2000, one of the youngest, interesting. And it did. There was no new build activity since 14, 15 until a couple of years ago.
Thank you. 5 minutes. Okay. So looking ahead, what are the key market and credit trends that you expect to impact ship financing in the next 5 to 10 years? And how should shipping companies position themselves to meet future financing requirements, both in terms of market strategy and financial resilience? Someone from the owners panel made this comment about the umbrella and having it when you need it. And what do you think? And the previous panel mentioned about the black swan and pink flamingos. So it depends. How do you view the market and what they have to do in the next 5 to 10 years to be?
In my opinion, there are two. The first one is not a black swan, maybe it's a gray swan, meaning that there is a risk, it has been discussed, but not as significant, which is Basel IV, or Basel 3.5 to be more precise, because the implementation of Basel III, basically. And that will gradually start from 2027, in a couple of years, over a period of 4 or 5 years, meaning that very soon banks will need to start pricing it. We already know that a few large European banks need to start pricing that in from now, and they already changed their appetite, meaning that margins will go up, and I'm talking about margins that were below 2%, and for that particular bank will need to go to above 2%, despite everything that is being said about competition and etc. Now the Asian financiers are in a competitive position because they are more relaxed about it. Yes, they said that we're going to implement that, but whenever we feel like it, so maybe never. That's one approach. And the other is geopolitics. Because let's face it, we are becoming a globe that is not as interconnected as it was before. And we have two well-known wars that unfortunately are still ongoing. And if there is more tension in the east side of the world, the way at least we look at it, I wouldn't be surprised if we are going to experience much more turbulent markets, again, in the finance space, because as I said, most of the growth over the last 15 years came from China. If China, for whatever reason, is not there, you can imagine the consequence of that.
James, you want?
Yeah, I think, you know, it comes back to, if I were to speak on behalf of the lenders, you know, it's to not go margin chasing and client chasing. You know, it's the Western banks, because of the requirements that we just discussed and because of the Poseidon principle and all these, you know, you end up chasing top credits with new builds, with charters. That's a sort of, you know, then you get your picture on the wall at the bank if you do a big one there. But if everyone chases the same thing, the margin squeeze and it becomes immense, and you know you have to give that, this, and the other. And we've seen it before, and we're going to see it again, and we're seeing it again. You know, so if you're a bank, that's one of the things you need to. Everyone says they're counter-cyclical, but I think the industry that's the least counter-cyclical is probably major banks. But you know, just try for once to think differently. Because, you know, whether it is geopolitical or if it's other things coming, this is a cyclical market. What goes up must come down, and it's going to come down. And, you know, where's RBS lending today in shipping? Not many places.
Thank you. Wilhelm?
And I think in shipping in general, it doesn't really matter if you're talking about financing or chartering or just plain ship owning. I think optionality is key, and I think optionality is generally underpriced and undervalued in shipping. I think the value of having options is huge because of the cyclicality, because there's so much upside, but you have to have the optionality. If you start closing doors, it might be cheaper in the short run, but I think it's going to be super expensive in the long run, just because you are missing a lot of opportunities. So whatever you can do to keep as many options as possible open is what I would do.
Thank you. Nicholas?
I think on the financing side, we are in a black swan right now. Right? We come after years of free money. We have stimuli around the world in all economies, major, developing, etc. And we also had very good markets on the equity side, on the earning side, which repaid everything, more or less. So we are at a point in time where capital is abundant. I don't think it will be the same in 5-10 years. The expectation is it will dry up for one reason or another. Besides, shipping is not the only industry most of the financiers look at. There will be better opportunities in other industries, they will move to that. We've seen it in the past. So I think a company that looks forward and has to tackle, you know, questions such as how do I renew the fleet, how do I refinance, all these things we discussed today, they need to pave the way now that they don't need it. It's easier to ask something if you don't need it than when you need it. You can sort of dictate the terms, as Iraklis, I think, said, if you pay 50 basis points more now or 25 basis points, at the end of the day, it's $75 a day or 100. If that makes or breaks, you're in the wrong business. So now is the time to develop these relationships. And especially on the alternative financing side, most of the alternative financiers have other pockets of money as well, not just the debt side. They have equity side, they have mezzanine side, they have appetite for joint ventures in sector segments. So that can grow the business beyond the initial discussion. So it's a more of a holistic approach on how you move forward rather than pricing and LTV and just a margin discussion.
Thank you very much, everyone. Thank you.